Yo, what's up, guys? It's Saturday, August 31st. Sorry I couldn't make a video yesterday. I had a little emergency. My barbecue just burst into flames. Flames were leaping up. I guess I hadn't cleaned it in a while, and there was a lot of grease down there in at the bottom of the barbecue, and the thing just burst into flames, huge flames shooting up. I had to luckily I have a fire extinguisher in the house, and I put it out, and then I spent the whole rest of the afternoon into the evening cleaning up. It was a big mess. But anyway, it's all taken care of. So yesterday the Dow made a new high. All the averages were up. As I was saying, this past week, we had that Social Security payment on Wednesday. Yesterday was first of the month payments. So like I said, coming into last week, it's a big leading flow week. And I mentioned the fact that leading flows have accelerated. I was a little surprised by that, but it could just be due to the fact that last week we had the combination of Social Security payment and yesterday's leading flows, and that was the impulse, that was the driver. We're gonna have to see now. It seems to me, let me just say this, that flows are very, very strong. Leading flows are very strong. By the way, NASDAQ has not made a new high, and the S&P has not made a new high. It's the Dow, and the Dow, that's 30 stocks. Dow futures are not that widely traded. Volume is extremely low compared to the S&P. The S&P is the bellwether futures activity in the S&P. It influences the overall average with this kind of automated trading and stuff like that. But anyway, NASDAQ did not make a new high. S&P did not make a new high. It might. They might. The point I have been making for a while now, if you've been listening, is that the key element that is going to change the dynamic over time is going to be the rate cuts. That's going to be the rate cuts. And I stick by that. Remember that a lot of what we have seen recently in the past several months with respect to this stock market rally has been enthusiasm or expectation over the Fed cutting interest rates. And again, I bring you back to the reality, the understanding of the fact that all throughout the rate hike, regime of the Fed, the entire time when the Fed was raising rates, we had universal predictions of recession and market crash. I was the only one that I know of anyway, and also the only one giving, the correct explanation as to why that was not going to happen. I said, and I gave the exact date, the exact turning point in October 2022, where I said we would reach an inflection point where the rate hikes, the fiscal transfers from the rate hikes, the interest income transfers into the economy from the rate hikes would offset the discounting effect of higher interest rates. And that came in October 2022. I gave you the exact date and the exact bottom when that happened, okay? And then we've been going up since then, and all of 2023, the biggest economists and the biggest analysts on Wall Street were universally predicting a recession and that the market was going to crash. And I said, as long as Congress raised the debt ceiling and we continued with these flows, that was not going to happen. Fast forward to today, where, like I said, a lot of the recent run-up has been related to expectation of rate cuts. According to the monetarist, understanding, which is wrong because, again, it's a single variable understanding. According to their understanding, this is, the fix all, the be all, the end all for the economy. It's going to be the soft landing. They have all this terminology for this. It's just kind of, made up, the soft landing. And I'm telling you right now that the exact same thing is going to happen with the rate cuts as what happened with the rate hikes, only in reverse. The dynamic of rate cuts is the following, as I've explained many times. It slows and eventually reduces or takes away those interest income transfers into the economy. And I've mentioned the fact, I've cited the number actually, that we're now at over $1 trillion this year alone, this fiscal year alone. Still have a month left to go. Over $1 trillion of interest income transfers into the economy. And that is direct transfers on government securities and also what the Fed has been paying to the banks on interest on reserves. And even with that additional, now think about it, if Congress came out at the beginning of this year and said, we're going to introduce a new spending program of $1 trillion. That's going to be on whatever. It could be on defense, or it could be a brand new trillion. People would be going nuts over that. The market would remember what happened during the COVID when I think they came out with like a 2 or 3 trillion package. It was like a 3 trillion package. We went straight up out of the COVID, even though the entire economy was in a lockdown. And that's why we had the big inflation impulse, was because basically the economy was shut down. It couldn't respond to the added demand that was created from those fiscal transfers. Okay, so that's when you have a problem with inflation. I've said before, if you're a capitalist, which I presume most of you are, then it's impossible to argue that spending by the government will create inflation. Because if you are a capitalist, you would realize that the government spending induces the private sector to respond to that demand and create more supply. So the supply goes up as the demand goes up. Only in a case where the supply is not available for whatever reason. Maybe the natural resources are not there. Maybe the labor is not there. Maybe the technology is not there. Maybe the productive capacity is not there. In those cases, yeah, then prices are going to rise because they're not being met with additional supply. But if you are a capitalist, you cannot argue, because you would be contradicted. Because the profit motive is what drives capitalism. And when capitalists see the demand for goods and services, what happens? They respond to that by creating the products and the supply to meet that demand. You can't be a capitalist and argue that spending is the fundamental foundation for all capitalism. You need customers. Okay? So, what I'm saying is that what we're going to see from the rate cuts, and again, I've said so many times, we're going to come back and we're going to revisit this. Right now, a lot of you are saying, oh, that's wrong. We're just going to keep going up and up and up. The market is going to, I know what I was saying. That despite that $1 trillion, that's what I was getting into. The $1 trillion increase in transfers this year, still have a month left to go in the fiscal quarter, in the fiscal year. $1 trillion added. The economy is growing from 2% to 2.5%. That is very tepid, very slow growth. Okay, we've seen unemployment rate rise. We've seen initial claims for unemployment benefits rise. So, that's with the $1 trillion addition of transfers of money into the economy. Think about that for a second before you go on one of these crazy rants about how, the market's just going to keep going up, you're wrong, and this and that. $1 trillion added this fiscal year, and the economy is growing between 2 and 2.5%. And I will repeat again that the stock market will follow the economy. Again, NASDAQ did not make a new high. The S&P did not make a new high. It was the Dow Jones, that's 30 stocks. And by the way, to me, that makes a lot more sense. I never could understand why people argue or the markets react to lower interest rates, that technology and NASDAQ, which is mostly dominated by technology companies, why are interest rates so impactful? I mean, tech companies are usually loaded with cash. They have very low debt. Industrials, like the 30 stocks in the Dow, yeah, industrials I could understand. They have much higher debt ratios. Interest rates are a factor. So I've always kind of thought, like, if rates come down, it should be positive for industrials. If it comes down, and even if it goes up, why is that negative for NASDAQ stocks? That, always baffled me. I think it's one of these ingrained ideas on the part of investors, like so many other things we see, that has no real basis in reality. It's just like a belief. So they react to that. But anyway, the rate cut expectation has not boosted the NASDAQ. All right. So these rate cuts, when these happen, this is the factor, because I'm saying now that the leading flows are still very strong, not the net flows. Okay. As a matter of fact, I just looked at yesterday's data, which is a little bit skewed because of a calendar issue. We'll have a better idea on Tuesday. But that's in a downtrend. In other words, the year over year, when you look at net government transfers, that's the leading flows minus the taxes that are taken away. Those net government transfers are dropping year over year. What does that mean? Like swimming pool analogy, less water is being added to the pool compared to last year. Okay? You got the pool, you got the pipe going into the pool with the water flow. That's the leading transfers. And you got the drain at the bottom of the pool. That's the taxation. So that's actually going down. The water level's actually going down. It's not collapsing. It's not being completely sucked out of the pool, but it's slowly coming down. And that should explain the slow deceleration we have in the economy. All right? 2%, 2.5% growth. At the end of last year, 3.2% growth. The year before that, 4, 5, 6% growth. So you could see it's not like it crashed. And that's another thing I see a lot of you guys are saying. Oh, Mike, it didn't crash. Who said anything about a crash? I never said anything about a crash. I said the market is going to follow the economy. And why are you guys so fixated on crashes? I don't know how many times I've explained in my career, throughout the time that I was a floor trader on 4 different futures exchanges, I spent almost my entire time down there shorting the market. And you want to know something? The only guys I ever knew who made big money as independent traders on these exchanges always played from the long side, and they were like, you could count them on one hand. Everybody else in those pits, and I was there, man, everybody else in those pits were selling all day long. We wanted to crash. I don't know why. I always said you could write some kind of a psychological thesis on that. If you're in school getting a psychology PhD, you might want to check into that. Although unfortunately the floor trading doesn't exist anymore. But it was crazy, man. I spent my whole entire time down there wanting the thing to crash, no matter where I was. Okay. I was in oil, I was in gold, I was in the S&P, I was in stock in the New York Stock Exchange. I spent my whole entire time wanting the thing to crash, selling like an idiot. And a lot of you people out there, you're like, it didn't crash. It didn't crash. Like you're upset, like you're pissed off that it didn't crash. I never said it was going to crash. I said we're going to go into a period of declining economic activity, slowing economic activity, and most likely, I'm saying this right now, most likely a recession in 2025, because I also said without policy changes, we're facing, first of all, the fiscal drag from rate cuts, the fiscal drag from the Trump tax cuts that are expiring next year. That would have to be, Congress that extends them. Okay? And the fiscal drag of smaller increases in the cost of living adjustment for Social Security, Medicare, Medicaid, veterans benefits, all those things, all right? I mean, 2 years ago, those things were up, Social Security was up almost 9%. That's a significant increase. Last year was up almost 4%, I think 3.7%. In 2020, or this year was up 3.7%. In 2025, it's going to be up just barely over 2%. That's a deceleration. So you're going to have a deceleration from those interest income transfers. You got the Trump tax cuts that are expiring. You have smaller increases in the cost of living adjustment. I mean, I'm telling you all these things, and you're like, oh, it didn't crash this week. You're an idiot. Sorry. I mean, again, we're going to come back and revisit this. That's all I can say. Anyway, it's not normal that I do Saturday, but again, I had that emergency yesterday. I couldn't do it, so please like and subscribe. Thank you very much if you've already done that. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial, MMT Trader. That's it for today, folks. Enjoy your Saturday. Bye. And it's Labor Day weekend, so if you got some nice plans, that's great. Leave them in the comments. Bye.